Hey, before we get into today's episode, I just want to let you know I'm going to be speaking at the Flagel Small Business Lenders Conference in Orlando at the JW Marriott on September 19th. And not just me, but several folks from the Art of SBA family of shows will be there speaking as well, including our very own Alan Peterson, Sterling Birdsong, and Christopher Hackney, all from the BDO show. We'll be on the business acquisition panel and the BDO panel. It's going to be great content. You know, we don't gatekeep around here. So come on down to Florida and level up your game. We'll see you there. Now on with the show. LUMOS gets brought up on just about every episode these days because they are changing the way SBA loans are underwritten, especially small loans. So I wanted to take a second to explain the power of LUMOS. So here's how it works. LUMOS' scoring model, Prime Plus, leverages over 1 billion data points to come up with a predicted expected loss. So now you can quickly and efficiently decision each new loan request. Guys, we're talking about auto decisioning on small loans up to $500,000. They'll even sit down with you to build out a customized credit profile that matches the risk tolerance of your specific institution. LUMOS is defining the next chapter of SBA lending, and it couldn't be coming at a better time with the rise of the small loan program. By the way, you can use LUMOS to score your existing portfolio too, so that you can see where the weak spots are before there's a problem, and that way you know where to focus your resources. Let LUMOS take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today. Hello, and thank you for tuning into the Art of SBA Lending. I'm your host, Ray Drew. The topic of the day, broker compensation. You know, I used to get asked, do you pay referral fees? Now it's, how many points do you pay? Broker compensation has been on the rise as competition for volume increases in the 7A arena, so I thought it'd be a good time to pause and reflect. For years, the SBA has been harping on borrower fees, fees charged by agents and whatnot. That's why we have the 159, the itemized invoice, et cetera, et cetera. They want access to affordable capital for small businesses, and they don't want excessive fees standing in the way, and rightfully so. But what I haven't heard discussed is the amount of fees that the lenders are paying their referral sources. On one hand, if a lender wants to pay higher fees, why not? It's a free market. Where it could become a concern, though, is if those behaviors led to higher interest rates paid by borrowers and or less competition. So let's break it down. In a normal environment, some lenders don't pay referral fees and some do, and if they do, they pay a point. But when the market gets really competitive, like they have been in certain industries or in certain periods in a cycle, some banks that need to hit certain production goals will say, well, what if we increase our broker fee from 1% to 2%, and in some cases even more, to increase our volume? Now think about that for a second. Where are these deals coming from? Brokers, right? So the entire thought behind what I just laid out assumes brokers will now send their business to Bank A instead of Bank B because Bank A is paying them more. So if the bank's plan works, wouldn't that mean that those deals, those new borrowers are getting referred to that bank, not because they have the best option possible for the borrower, but because it's the most lucrative option for the broker? And that's where I start to get a little concerned. So let's switch gears now to the broker side. And we're talking loan broker here, by the way, someone focused on helping businesses obtain financing. I was a loan broker for 3 months before coming to TrueLiant. The amount of time and energy I put into a deal with no guarantee of it ever closing and getting paid is a lot. Good SBA loan brokers aren't going to work on a deal for a point for the most part. So when a bank offers 2 points, the broker in their network sees that as an opportunity to grow the business's top line simply by working with that bank. So what's the issue? Well, if the business owner is coming to the broker as someone who can represent them in the marketplace of SBA loans, how much variety are they really gaining access to if that broker is just going to be working with the banks that are going to get the deal done and pay them the most? The underlying issue with all of this, to me, is the potential that banks are buying business, not earning it. It is very likely that borrowers are being steered in certain directions because of the referral fee, and we can debate whether that's ethical. Now, on the cost side, this is probably the bigger concern for the SBA. Are banks charging higher interest rates to be able to afford these higher referral fees, essentially passing on the cost to the borrower? The referral fee should not impact pricing, but it does. This is not a secret. Everyone is aware of this except for the borrower. The BDO comp plans are written in such a way that lenders have more room to pay fees if they're getting higher pricing. And inversely, if the pricing is low, it's harder to pay higher fees. And I get it. The bank created the SBA department to make a certain ROI, and you've got to generate certain returns for it to make sense for the bank. But at the end of the day, the small business owner doesn't understand any of that, and they should. Getting a 159 DocuSign package 2 days before closing doesn't count. By that time, it's too late. Honestly, these are all signs of a broken market. I'm generalizing here, but banks don't know how to market. Banks don't know how to nurture leads, and banks don't know how to provide the type of handholding that many brokers provide. And brokers need to be compensated for filling this market void left behind by the banks. So here's my solution. I think the SBA should regulate the amount of fee a bank can pay a referral source, limit it to 1%, but allow the broker to charge whatever fees they want. This ensures the brokers, who are by and large controlling the flow of deals in our industry, can go to all lenders without having to worry about how much they're going to be paid. And that competition should drive down cost. Meanwhile, brokers can earn what they need to earn, and the good ones will probably charge more because they provide more value. And brokers sell those fees upfront to the borrower day one, so it's fully disclosed. And guess what? If the borrower doesn't like it, they can move on to the next broker. They're not hard to find. So with that, I'm going to bring in our panel of Art of SBA contributors. With me today, I have Charles Green, Senior Vice President at Harvest Small Business Finance, Kay Anderson, Senior Vice President at Live Oak Bank, and Javier Jorge, CEO and founder of ChatBiz and the newly appointed SBA Director at Locality Bank. Panel, thank you for being with us today. Javier, congrats on the new gig. I'm going to go to you first. Are you seeing pressure in the market to pay higher referral fees today?
I think your intro was right on the money, Ray. It is a path of least resistance. It's an easy way to goose your revenue when you need it on the production side. And, it's a tried and true method that has only gained momentum over the years. I remember when 1% was the standard, and now I see, institutions that won't be named that are going to 3+%, depending on structure and, specification, right? And in our career, I've seen it just go up.
Yeah. So, Kay, I'm going to go to you next with this one. When you're having conversations with BDOs that are considering coming to your bank, what are you hearing from them in terms of needing to pay referral fees to generate their business?
I hear that many of them do need to pay fees higher than what we typically pay anyway, in order to get more deal volume and therefore increase their personal compensation.
And so do you think 1% is the norm, or are you seeing some paying higher?
I see some paying higher for sure. Quite a few have a sliding scale, it seems like, for volume. So the more volume you get, you refer to a particular lender by a broker, the higher their fee.
Okay. Charles, man, you caused quite a stir the first time you were on the podcast. You told me that you don't really pay referral fees. Have the market pressures caused you to rethink your strategy?
Let me say I represent my views here and not those of my employer, because there's a variety of different folks that do business a different model than I do. But in listening to the remarks in your introduction and afterward, it's just, to me, a situation of the tail wagging the dog here. And the root of this is not necessarily the brokerage community, it's the banking community that's failed to, number one, recruit a talented group of business developers who can go out and find and qualify and package transactions that are going to get successfully done. Two, it's the greed of the C-suite, who has just got an insatiable appetite for the fee income, the premiums coming off these deals, to the point where they're looking for volume and are they overlooking credit? Are they overlooking their customer? And, they don't even know who their customers are. And it's, it's a structural issue I see that can only lead to some, a crash at some point, like we saw in the housing market when there's all those crazy loans being made back in the late 2000s, Alt-A and, no credit, no problem kind of thing. We saw this again in the 90s, with the money store. They were doing 100% loans on commercial properties, and they crashed and burned, under the weight of loan losses. So I'm staying out of it. To answer your question, no, I don't pay broker fees because I recruit all of my own business.
Well,
So I disagree. I would say that at Live Oak, we formed what you would call our BDO team under the premise that we wanted to finance a transaction that had a buyer, a seller, and an intermediary that could drive a specific closing date in a contract. And for us, we pay across the board typically 1%. But when I started this team, I hired several individuals that came from Wells Fargo. At the time, Wells would not pay referral fees at all. We had to train the lenders to work with intermediaries. But we don't do that haphazardly. We screen the intermediaries thoroughly, and we monitor everything they do, not only the loans they bring us and the volume, but the debt service coverage, the default rate. We know which intermediaries bring us deals that are not the quality that we want, and we take action accordingly.
But would you say, Kay, that is how banks behave across the board, or is that unique to Live Oak?
I think it's unique to Live Oak. I mean, because we will not work with a referral source that consistently brings us transactions that aren't the quality that we want in our portfolio. So it's not like we are just accepting deals from a referral source, a broker typically, randomly at all.
Well, and you're able to, given your volume and some of the bigger brokers, you're able to track that default rates to referral sources.
We track it carefully. Everything from, we can track FICO scores by broker by just clicking a few buttons, and we do that. We watch them carefully.
Interesting.
Well, that's very admirable, and you certainly are the outlier from my observation over the last 40 years in this. And Ray, I don't know if I ever told you this, but I had my own brokerage shop for 5 years. I was a banker for 5 years, and then I opened a brokerage shop for 5 years. And in that time, we had a marketing agreement with another casualty of years gone by, Heller First Capital. And we were getting a nice, large referral fee for the transactions that we produced for them. But we did everything from soup to nuts. We had it. We did everything in the transaction except underwriting it and having it with having credit authority. And for that, we were compensated appropriately because they didn't have a BDO in this region at all. And we just opened up a new market for them.
Yep.
But today, it's that auction thing where you just see a broker who's got a decent deal and he's just shopping it out to see what he can score. And I think that's certainly a problem for the borrower, and they can't be exploited too seriously because we do have a rate cap, but it does open up a lot of questions that the SBA gets very concerned about.
I just don't like it. And maybe I'm just sour, but there's been many times I've just decided I'm going to call 10 brokers today and just see what's going on, maybe get a new deal. And how many of them, the first question out of their mouth is, how many points do you pay? And I'm just like, maybe I'm biased, but I think I have an incredible option for your borrowers, and you don't even want to give them access because I'm not paying, 1%. So that's kind of like the basis here, Javier. But why does this work? Why can a lender go to market and pay an above market referral fee to generate more business? Like, how does it actually work? Walk me through the steps from your perspective.
Well, from a model perspective, I think what they're doing is you're outsourcing your business development activities, right? So you're taking what, to Charles' point, which is a lack of development on the front end of your department, and you are just moving that cost to a pure variable per transaction broker fee, right? I mean, 1099 it out and, bring in as many people as possible through those funnels. That's a strategy. I think it's not a strategy, to Charles' point, that is sustainable in the long run, right? Because then you lose that original banking model, which was consultative support. Philosophically speaking, our jobs as intermediaries, financial intermediaries, is to efficiently allocate capital, right, from savers to investors. And if we can't find the right investments, which in this case are SBA loans and entrepreneurs, then we're failing the bargain that we have with the community. And I think it's a dangerous trend. It's a trend that we've been seeing. What do you guys think for the last 20, 30 years, right? And I think a lot of it's driven by the commoditization of banking, where a lot of the components have been widgets, right? So, like the wells, making sure you hit a certain number of credit cards or bank accounts. But the sophistication of the banker has changed, right? So the relationship isn't there anymore. So how do you maintain revenue? Well, pay a broker, outsource it.
And Charles, I was going to ask you here, if you have a good product and a good broker, why would you need to pay 2% plus to earn business?
Well, I don't think you get that kind of value. Now, there are brokers who give you a phone number and introduce you to a customer, and then there's brokers who really come with a qualified package, I'm told. I've never seen it, and Kay, I guess you've got them all. But the phone calls that I have fielded over the last 5 years from brokers, they barely know how to spell their last name, it seems like. And they put me onto somebody who's not really qualified or who hasn't really been screened. And I've got to start over. And maybe I get a tax return that's 4 years old, but really, I've just never found the value. And I guess maybe they know after your podcast, it's so pervasive, right? Not to call me.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. So it's no surprise that they just created their, wait for it, 1800th custom business plan. And they wanted me to thank all of you for helping make that possible. In fact, Rapid Business Plans hosts an annual lender appreciation event to show how much they appreciate your support. Tyler Palooza, which is of course named after their #1 referral partner this year, will be hosted at Bethany and Ross's home in Neptune Beach, Florida on Saturday, October 12th. For more information about the event or to find out why so many top producing BDOs recommend Rapid Business Plans to their small business borrowers for their business plans and feasibility studies, click the link in the description below. Now back to the show. So this is interesting. So the bank hires a BDO and pays them to find deals for the bank. And then the BDO goes out and pays brokers for those deals, Kay. Does the broker fee come out of the BDO commission? Should the broker fee come out of the BDO commission?
It does not at Live Oak. I can't speak for other lenders. Well, I guess I can tell you that the people that I've spoken with in the past, say, 6 months, the BDO commission is impacted in some way, I'm told, or the lender is told by credit that if they're paying a referral fee, that they must increase the rate a little bit. They must get max pricing. I've been told that as recently as yesterday. So,
and yeah, and I've heard that. I mean, Charles, do you think there's some hidden costs being passed on to the borrower via the interest rate from shops that are paying higher fees? In other words, is the rate, connected to the broker fee, do you think?
You'd be crazy not to, and I think you can justify it, but typically you're going to have riskier deals coming out of the brokerage community on average than you do a stellar, higher, more competitive deal that could be originated in-house. Mm-hmm. And let me throw one other cost to the bank about all this is that I generate relationships. Okay, so in the last 5 years, I have one client I've done 5 loans for. I have 4 others I've done 3 loans for. I have another half dozen I've done 2 loans for. You think the broker is coming back to you because he brought you the last deal? Not necessarily. Maybe someone else would pay him a higher deal and he'll take that second loan and the third one to someone else. I don't have that problem.
Javier, did you want to jump in there?
Well, to counter Kay's point, we do in my shops have always instituted a split cost with a BDO and a lending institution to cover broker fees, and that's designed to de-incentivize my BDOs from using the broker channels. Do we use brokers? I have a core set, I think, of 3 or 4 that I've had my entire career, but those are primarily relationships that go deeper beyond just one transaction. And then I think another level of conversation, we're using a very broad term of broker. I think Charles already touched that hit, right? There's introduction and then full package. And we can talk about, is that broker generating 100% of their income from broker activities, or is that a supplement?
Right.
Are they, a bookkeeper, or are they a consultant CPA, where this is a normal add-on function? I think all of that, should be in your consideration on this topic.
That's true. Well, then do you think that, like, how does the conversation change when you're talking about one or the other versus like a loan broker making all of their revenue from doing this versus like an add-on for a bookkeeper or something like that?
I think it aligns with your proposal, Ray, about incentives, right? Because if this is a portion of their income and not the entire income, you can then start talking about aligning long-term incentives on the benefit of the borrower, right? So you can imagine if they are their consultant CFO, this one loan transaction is a piece of a larger strategy for execution over time, right? So the broker isn't just going to go away after the loan is done, right? So I think that does increase the reputational risk that the broker has, or commitment to the deal, right? Because it's not just that one process. It's much deeper than that.
Mm-hmm. Okay. Well, and by the way, I feel like there's a difference, and I'm going to go to Kay with this, between a shop that innovates and find ways to be more efficient and cost effective and wants to share those savings with their partners in the form of a higher rev share split, and those who have an inferior product and are paying brokers more to get more looks at deals that they wouldn't have otherwise gotten. But how the heck would a borrower know the difference?
Right. I think that the borrower, I think part of the failing that we have as an organization is that we don't educate the borrowers on the front end concerning full transparency about fees and what they're paying, right? Certainly by the time a term sheet is issued or a proposal letter, the borrower should understand all the fees associated with the deal. That's our view. And I think that as far as the quality of the deals that we see, our underwriting is extremely conservative and very thorough. And we want to see every good deal for every transaction that is SBA eligible. And if it comes through an intermediary, we are absolutely fine with that and encourage it. So just a different viewpoint.
Yeah, and I don't think the borrower knows how much the lender is paying the broker at the term sheet level by and large, I would say.
I agree, and they should.
Yeah. All right.
Can I raise a point here? It's maybe the right place. What seems to be overlooked by the industry, and this is in many industries, but why isn't the borrower paying for their intermediary? Because they're the ones who've hooked up and who've gained this, confidence that this person can get them financing, and they should be paying the fee for that. And I don't know that the banks really would have to if that were appropriately distributed as another loan cost. And Kay, you're right. The borrower doesn't understand loan cost, unless you're explaining them on every level as you go through the process. But this intermediary has been able to attract that client and get their confidence. Why can't they sell them on, here's what my cost will be?
Yeah, and by the way, do you know how I know the broker fees have gotten over their skis? In a normal industry, when you do a deal and you make a certain amount of money but you got referred that, you give it like a 10% cut to your referral source. Here, if you're a BDO paying 2%, your referral source is probably making more than you. That just doesn't seem to make sense. Javier, I'm going to play devil's advocate for a second. We're a commodity. If some banks want to work for less, that's on them. As long as the borrower is taken care of and has access to an adequate loan, why should anyone care?
Well, at the end of the day, I think the core was back to cost and friction, right? So why should we care? Because if the cost of capital increases, there's less capital being utilized in our economy. And that just adds additional friction in your, small business economic activity, right? I think if you really look at what services a broker provides, I think it falls into one of three categories, which would be first marketing, right? Finding the business, would be second organization and documentation prep, and then third, which is just holding the borrower's hand through the process education. I think not all of them do all three well, and some probably differentiate in one of the three as far as their main value proposition. But if those three activities, I think, were better resolved within the industry itself, the broker community, shouldn't need to exist if we did a better job.
Let me toss out an idea, okay? So the industry, by and large, compensates BDOs based on the interest rate they charge, or the premium that loan earns, right? And the more volume you do, the bigger cut you get. That's correct. Those are the typical commission.
That's common.
Those are the common comp plans. So should we pay brokers the same way, do you think?
Should we pay brokers the same way? I would be in favor of paying brokers according to the quality of loans they send and according to the volume that they send. Those two criteria. So a scale would be great, but we won't pay any intermediary more than 1 point. So the scale would have to start at 0 and go up to 1 point, which probably wouldn't be very competitive given that all of the brokers that we use expect that fee.
But would it make sense? And we don't have to talk specifically about Live Oak, but like if we were just in a make believe land and we started a bank, which is what you guys did, I guess. But like fast forward to today, so would it make sense to, because the idea of the tiered approach basically says, okay, you've worked with me, we've done a couple deals. Now that next deal, you're going to make even more. And so it incentivizes the broker to keep doing business with you because they're going to earn more, but they've already done a few deals at a normal fee, which basically kind of is like an act of good faith in a way. Is that making sense?
Mm-hmm. Yeah, I think, when we started Live Oak years ago, our fee structure was probably different than it is today, right? We were more dependent on, we certainly were dependent on the secondary market when we were a de novo bank, just a startup. We're not any longer, but yes, we occasionally did pay brokers based on the volume that they provided to us. We felt, get away from that though, in the early years.
Okay. Was there any reason why that you got away from that?
Just because we wanted consistency in the message and just kind of draw the line so that it wasn't a conversation every single time a broker brought us a deal as to what we were going to pay him. And then they talk and it was like, okay, well, you're paying this broker a point, you're paying this one 1.5 points or whatever it might have been in the early days. Not any longer.
Okay. Yeah. Keep it simple. In other words.
Yeah. Keep it simple.
By the way, guys, I don't think anyone is at fault here. Banks aren't doing anything bad by paying higher fees. In fact, maybe it's an act of generosity, and brokers for sure aren't doing anything bad by trying to make money. If someone wants to pay me 2, I'm going to take 2. It's the system that I have a problem with. I feel like we as an industry, Javier, are doing ourselves a disservice by not adapting quickly enough to the needs of the modern day small business owner. Would you agree or disagree?
I couldn't agree more. This is a topic that, I feel strongly about. I do believe that as an industry, we're late to adopt technological trends and opportunities to fill these gaps efficiently. And I think I've said this line time and time again, Ray, on your show. If as bankers, if we're not at the table, we're on the menu, right? And when there is an institution that figures out how to meet those needs, educate the borrower, and satisfy their access to capital in a sustainable long-term fashion, they're going to eat all our lunches. So, and I'm optimistic that we all have the same expectation or drive, which is to help our small businesses, our community access to capital. And we all know that, the small businesses need help, right? We cannot do some of the work that these high quality brokers do, right? Which is educate, support, and provide the additional value that, as we just talked about, the industry has not given.
Yeah.
But I think there's a way.
Yeah. Well, let's switch gears here and talk about double dipping. Great Seinfeld episode, by the way. Do you think, Charles, that brokers should be allowed to get paid by the bank and the borrower? I mean, SBA makes a big deal about it. You know, you can't charge the borrower twice for the same service, but you can, as a broker, get paid by the lender, then also charge the borrower for specific services provided. Of course, you got to get the itemized invoice. What say you?
I think if they provide a service to the borrower and they itemize that as per, I think anything over $2,500 has to be itemized, then they deserve to do that. The 159 gives the right to the borrower to go back with buyer's remorse and to complain about it, which is not exactly capitalism at its best. But if they are providing a bona fide service ahead of the sale, and then they refer the bank, get paid strictly a referral fee, then that's been the precedent for nearly 30 years. There's a little history here, though, and it's a risk that I haven't heard mentioned yet. Back in 96, 97, SBA floated the idea pretty openly about just eliminating third-party origination. Just said, we don't need brokers. They just make the cost go up. They're not really accountable, and they're out here kind of operating on the rogue. And I could name a few names who they were pointing their finger at. And we had to scramble. We actually, these were during the years I had a shop with 3 partners generating loans, and we organized a very loose alliance of brokers around the country, had our own little powwow at a couple of NAGLE meetings, and went to Washington and lobbied directly at the agency for this to back them down and calm them off about that. They came up with this 159, and it's been through a couple iterations since then. But
what was the argument you made in DC as to why they shouldn't do that?
Well, free enterprise, because I was a banker who had plenty of skills, and I was doing ethical work, and I was preparing packages as good as any banker that I competed against. And why could I not make a living of that as an independent rather than having a job inside the bank?
Yeah, that makes sense.
And they were pointing at, I won't name names, but I'll just say the city of Atlanta was very prominent of their target list of a particular broker who probably put 10 banks in their grave through just flagrant, generating a lot of fees with no accountability. Accountability is, does anybody have a clawback provision for broker fees? I'm a BDO, and if that loan hits an early default, my commission is recoverable.
Right.
Because, and I don't have any lending authority, so it's a little bit of a, wasn't my fault. But how about that broker out there who you gave 2 points to, who may have covered up something or not withheld,
So true. I don't know who that broker is, but we'll put that on our Patreon for our paid subscribers. Just kidding. So how does the secondary market play into this, Kay? Because I'm a little conflicted here, because on one hand, I think the secondary market attracts more competition, which you would think would drive down costs for borrowers, but it also turns banks into crackheads.
So, how does the secondary market play into paying broker fees?
Yeah, do you think it helps or hurts this conversation?
I think that paying broker fees in times of increasing returns in the secondary market is what happens. And I don't think that it is helpful to the small business owner.
Well, that's a good point. So when the premiums went through the roof for the people that were selling them in like 2021, right? Then broker fee, I would assume broker fees were at an all-time high at that point.
I don't know that, but I would assume so too.
So why do you think that would be a bad thing for small business owners if the banks at that time are sharing in the revenue with the brokers bringing them the business in like an ultra competitive market?
I just think that it encourages behavior because the compensation to the referral source potentially is so much larger than it would be in more normalized times in the secondary market.
You know what I forgot to put in my notes here that I should ask? PPP. We got to a point where brokers were getting paid for PPP loans. I was not expecting that, because we all were like,
Yeah, they
trying to
didn't.
save the, small businesses of America with PPP, but like there were brokers that were making a killing with that.
Well, PPP was set up, number one, to mobilize quickly with a 5-point commission paid to the banks that distributed them, and it's kind of like you couldn't believe your eyes. That's a pretty good rate of return for what was going to be a lot of work, but obviously a lot of the pitfalls were they ignored tens of thousands of borrowers who only qualified for $5 or $10 or $15,000, and the ones who obviously didn't need it sometimes got $10 million, $15 million PPP loans.
There were agent fee provisions inside the PPP. I remember that the agency allowed for the institution to share in that fee with an agent if the agent helped the small business in the preparation of their PPP application and documentation. The funny thing is the incentives internally were those particular agent deals became less attractive for the bank to do because, when you're prioritizing a stack of PPP applications, you know what happened, right? We started with our existing client base, right? Prioritizing our balance sheet. And then we expanded with relationships. And then these broker level end up being tertiary or even further out in prioritization. So it kind of backfired there, I think.
So true.
Because there's only so many hours in a day.
It became a money grab.
Well, and helping, right? We're helping as many people as possible. But yeah, it definitely, I think, tying it all back to the secondary market conversation. When you have a juicy apple, more people want to take a bite out of it, right? So it just drives those incentives from that perspective. Why we have higher premiums, that's a bigger macroeconomic activity between interest rate environments and what we're charging. It does drive the behavior of institutions that sell because you're going to have main pricing pressures, which are going to be 10, 25-year structures and max price adjusting quarterly, right? Because that's where you're going to get the most premium gain on your return, right? But ultimately, the question that we need to ask ourselves, like, what's the point of the program? Are we increasing dollar amounts? I think year over year we're seeing that. It's a little leveled off, but I think that's part of the down cycle component that we've seen in the last 18, 24 months. But overall, is the system growing and evolving? Yes. Now, is this the way it should be? And this is the way it's going to be? I don't think so, and I don't think it should be. I think it's a great opportunity for improvement. You know what the biggest room in the world is? The room for improvement.
A lot of good catchphrases coming from Javier. Javier, I'm gonna just follow up with that for you here. The program is working, but the market is broken, if that makes sense. If I'm a bank, how do I compete to earn volume without having to pay brokers above market referral fees? Because isn't that essentially the solution here? Like, what are banks? Where is the room for improvement for the banks?
Build your brand, right? Figure out your differentiating a go-to-market strategy. Educate your staff to be mindful and supportive, and then provide service, certainty, and speed. Right? I think those are the main three competition items that we, as financial intermediaries, can really compete on. Right? Which is back to old school, core banking strategy, guys. This is not rocket science. And that takes time, it takes effort and investment.
And we're getting towards the end here, so we're going to start wrapping things up. But Charles, I just want to ask you, do you think we need more regulation or less regulation around broker fees?
The problem with regulation is the people, publishing those regulations don't always understand the nuances. And so they overfix problems that didn't exist, and they create new imbalances. But maybe some good old-fashioned collusion would be necessary. If the industry just sort of picked itself up and started promoting hey, we're going to adopt a standard, and maybe that could be a resolution that Nagel suggests, and everybody else just says we're going to go to the Nagel model.
That'll never work, but I appreciate that.
And maybe one other point though is if some of these brokers are so reliable and so screened and so productive, why not hire them as BDOs?
Ooh. Okay, I'm going to give you the last word here. Take a second. Do you have any last words for us?
I guess my last words would be that we believe in the intermediary model and compensating them fairly. We are consistent in how we do it, and we do actually manage what we are able to measure, which is performance of the intermediaries, the brokers, and take action based on that. When we started the bank, we did it with the assumption that people really only want to know two things from us. One, am I approved? And two, when do I get my money? So we try really, really hard to provide those two answers quickly, and we make that our differentiator. And so our brokerage or intermediary payment system is consistent with that, and we stick to what we know we're good at and don't overpay, we feel.
I loved this episode, guys, because, this is what this whole Town Square series was all about, because I have great friends that pay more than 2 or pay 2% or whatever. I've made more than 1% brokering loans. I have brokers that I love and we're all friends, but that doesn't mean we can't have this, conversation here out in the open, because why not? Like we talk about this stuff behind closed doors. Why can't we do it out in the open? It's nothing too crazy. And at the end of the day, I think more conversation around this is probably a good thing. So I appreciate all you guys for being with us today. Thank you. That's it for this one. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and the BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of the Art of SBA Lending. Ta-ta.